Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining us on the desk at the Nasdaq Market Site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, as well as Max Cabasso, Managing Director on Nasdaq's Market Intelligence Desk, and Chris Englebert, Founding Partner and Chief Investment Officer of Englebert Financial Advisors. We're here to discuss that the Santa Claus rally came early in 2025, and if 2026 could be the year that the rest of the 493 stocks in the S&P 500 start to outperform the Mag 7. It's great to have all of you with us on the desk, Dream Team, this afternoon. And Chris, I feel like we've kind of been asking this question for quite some time now, when we're going to start to get this broadening out in the market. But 2025, what we came into and what it delivered, certainly, I don't think was on many bingo cards this year.
No, and so we had a view that bonds were going to do better than stocks this year, and we were right up until about June. April we had the huge tariff tantrum, 20% pullback. The Magnificent Seven, really underperformed. But then coming out of that, we had, I don't know if you want to call it part 2, part 3, part 4 of the concentrated large cap growth rally. But what really looks to be happening, because of the broadening out and the fact that the small mid cap stocks have finally kicked in, and we're going to talk about interest rates in a second, our view is that next year, the other 493 stocks, there's a lot of companies that are showing good earnings. So earnings so far last week, about 16% of the companies reported earnings. They were up about 18% according to FactSet. This is another big earnings week. So earnings seem to be good, but the earnings seem to be getting better for the other companies that are out there.
Yeah, which will be nice to broaden out, Chris. I mean, we understand what the Mag 7 do, but how is it going to impact the structure and the models going forward of these other 493 companies?
So 2 points on that, right? We saw large banks came out last week, and we got a good look at a lot of the health of the bank, since we're also missing economic data across the board here. So now we're relying a lot on what the actual companies are seeing within their customer base. And Nasdaq came out with earnings the other day too. And again, consumer seems to look good, it's doing okay. Employment levels aren't awful, but there's definitely work to be done. We'll get a better look when the actual consumer-centric companies start to report later on. However, you did see General Motors do very, very well yesterday. You saw 3M do very, very well yesterday. And a lot of the companies there, the large cap names where money's flowing into, the Dow made an all-time high, crossed over 47,000. Now I remember Dow 10,000, that was when I was trading. So it's baffling. The Mag 7 is starting to see a little bit of unwinding, seeing riskier assets start to come out of the playbook a little bit. Bitcoin getting beat up a little bit, trading below 110 now from the peak at 128. Again, maybe just a blip, but who knows. 10-year under 4%, very interesting there. 2-year even lower. But to the small cap names, biotech has been on a run since mid-September. It's outperforming all the major indexes. The XBI is on a tear. A lot of it has to do with the Trump RX program and Pfizer and the large cap companies onshoring items there. But you're seeing, to your point, Chris, certain rotations into other forgotten assets on the small and mid cap names, or the other 493 in the S&P 500. And that bodes well coming into the very early parts of the Q3 earnings season.
Yeah, it certainly does. However, we have to, be aware of the fact that Apple certainly did contribute to the Dow run.
Yeah, for sure. Apple, we talked about actually off the desk, looks very good. There still can be strong performance in the Mag 7. I think it's really just about maybe the leadership changing. Everybody, there's a lot of, Brian on our desk, put out a note recently about the market will always climb a wall of worry, no matter what it is. There's been a lot of talk, a lot of bearishness about the Mag 7 AI bubble popping. I don't think it necessarily has to be that for others to perform. It's maybe just that kind of rotation into some of the more defensive names, whether it's staples, really more value funds that have kind of been left behind. They might have that place to step up in more of a sideways in the Mag 7, given the recent growth we've had and the continued spend that's going to be needed to keep that large cap tech growth going. So I think it's potentially just a rotation versus a big drawdown. Small caps obviously under a bit of pressure today, but have been doing well. It's that rate decision like we talked about. How do you get it? How much and how do you get it? Kind of what's behind it? Is it 25 basis points because we think inflation is under control and neutral rate should be a bit lower, or is it we're in some trouble? Now earnings is going to tell a big part of that. Like Chris was talking about, some of these more consumer names, I'm interested to see which ones perform the best, because we've talked about plenty of times here, that almost K-shaped and two-layered economy where the upper middle class is still doing fine, the lower class is not as well. You're starting to see it with credit card delinquency starting to pick up again. So those sort of things could be, whether it's canary in the coal mine, or does is that kind of Dollar Tree sort of staple, does that do well, or is it the other kind of high-end names that perform during the earnings season?
But Chris, you have to ask yourself, this resurgence of small caps, is that solely based on interest rates moving lower? I mean, that's your only fundamental reason to put money to work there.
Yeah, I think there's a couple things, and this is a long trade from the standpoint. I remember, way back in the days when small caps would take off, people couldn't get into them fast enough. It was not unusual to see a 40, 50, 60, 70% return in 1 year in the small caps because obviously a large amount of money coming after small caps. But I think what's happening is the bigger picture here is the onshoring, bringing things back, whether it's pharmaceuticals, whether it's tech. It takes 3 to 5 years to build these plants out. Once you start building these plants, a lot of these smaller, mid-sized companies provide electrical work, concrete work, et cetera, and the infrastructure to build all these big plants. And so, I'm very surprised that knowing that this infrastructure build out is coming over the next 3 to 5 years, there hasn't been more M&A in the infrastructure arena or those stocks. And I'm going to go out on a limb here, and we've seen through the AI trade, we've seen the utilities really soar. Well, that's also an infrastructure build out. Not so, yes, it's the utilities, but if you're building out this infrastructure, the U.S. power grid is literally 15 to 20 years behind where it should be. Many times it could be, everybody expects high-flying MAs to be in the mergers and acquisition, to be in the tech world or the biotech world. You could get some very pedestrian companies, in the utility sector that merge that you haven't even thought of, because it's cheaper to buy a utility company, the pipes and wires, or the infrastructure, than it is to wait 3 to 5 years to build it out. And a lot of those companies are smaller mid-cap companies.
Chris, is the government shutdown impacting deal activity?
No, not at all. It is impacting IPOs somewhat, a little bit. We're still waiting a lot of paperwork, but they are coming through. The final approval takes many times. You're seeing a lot of M&A activity in the biotech space, just used as an example. Multiple announcements today, multiple announcements last week. The run rate on an annualized basis for the biotech, and it's over 180 billion. It's best year in 4. So in this year, it's about 150, 160 billion year to date. So you're seeing a lot of quality names being sorted up, mostly by large cap for pipeline, which is standard, but you haven't seen those deals in a while. The interesting thing about the interest rate cuts, we're dialing in 2/4 basis points for at least this part of the year. That's going to help a lot of these smaller cap companies and micro cap biotechs on their funding side. So that means they're going to be able to put a little bit more money to work. It's not, the cost of capital is not going to be expensive. We talked about this a lot at the beginning of the year when the entire interest rate scenario got thrown out with the bathwater after they cut it back at the end of 2024. So if that continues and we get down to that 2.753% by the end of next year, that's going to go very well for those cash burn companies to continue their advancement, sticking in the biotech space, and potentially to the pipeline increase by the large cap names. So with the government being shut down, yes, some final deals are going to need approval, but it often takes the outside accounting and everybody else to get the paperwork through before it gets final review. And we're not there yet. So, but the number of upticks is very, very substantial. It's a great complement to increasing capital movement here in the United States. And that's what you want to see. Deals versus IPOs, they're both in the fix right now, which it's very interesting to see.
We'll go back to we're talking about with that helping. It goes back to what we just said, though, about how do we get there? Because if you start to see credit spreads blow out, those small caps that were expecting to have that kind of interest rate coming down for their cost of capital, if credit spreads start to blow out, they're not going to get that benefit anymore. So again, if that is your thesis, that it's just the interest rate cuts, and again, if it's in a kind of normal course, inflation's under control, the market's doing okay, the economy's doing okay, we're just getting it kind of to where they think the neutral rate should be, that's one thing. But if we get cut after cut because the Fed starts to see things kind of breaking down a little bit and they're a bit nervous, I don't know if they're going to get that same boost that they'd be expecting the way kind of we did earlier in the year, where it was, hey, we just had this crazy tightening cycle. Now they're just taking it off. If there's some issues under the water, that's the only fear for that space is credit spreads blow out. They're not going to get the full benefit of those rate cuts.
And we still need to see the inflation data, right? The BLS is going to be putting some out. Mostly, we'll see how reliable it is when it does come. But the inflation part of it was creeping up prior, right? And the labor market was absolutely on shakier ground than it had been for the last couple of years. Balancing that is going to be a problem. The chairman has done a good job of telegraphing it the last week, and again this week, and most of the speeches we've seen from the other governors have been kind of in that line, some even more a little aggressive than others. But if that's what we're relying on, there's a big hole still on the economic data that the BLS and the federal government put out there. We're relying on Beige Book reports, we're relying on ADP right now, consumer sentiment out of the University of Michigan. So it's the tertiary items that we used to look at, not the primary. And that puts a lot of traders at a disadvantage where they may just sit on the sidelines.
Well, I mean, anecdotally, it feels as if the economy is somewhat divorced from the market.
Well, we've been talking about this for a while. It's bifurcated, obviously to Max's point, people that have money are spending it, et cetera. So one of the problems, and this has been the talk for literally the last 18 months, are we going into a recession, not going into a recession? Are tariffs going to cause a recession? Right now, it doesn't look like the tariffs. The average tariff, depending upon the country, the product, et cetera, 10, 12, 13%. What I was saying back in the spring is that, with the big, beautiful bill, the U.S. economy and taxpayers couldn't afford a tax increase in the tax rates. So they didn't do that in the big, beautiful bill. Instead, they're doing that with tariffs. Well, now they're finding out that, the tariffs aren't really making that drag on the economy. So maybe it's not that bad of thing. And the Treasury is getting revenue like we've never seen before, so the deficit is bending down. Now, the question is it the control of the yield curve? It is a well-known fact that the Treasury Secretary wants lower rates, no question about it. He's been bullying about it, the president's been bullying about it, et cetera. And a lot of people are saying, well, if we have lower rates, we're going to spark off inflation again. Our point is that we think our call for next year, for 2026, is we're getting back to a normal yield curve. When you had a very flat yield curve where short rates equal long rates, you got a lot of investors crowding in CDs and Treasury bills, and they're not really allocating their capital from a long-term standpoint like they should. Well, getting the yield curve down, and whether it's 2.5%, 2 3/4, I don't see that sparking that inflation problem. And I think the normal yield curve is going to start to reallocate capital where it needs to be allocated versus hiding in short-term fixed income, getting risk. I mean, it was up last summer, you were getting 5 1/4 in a bank CD. Right. Now you're getting 3.75. By next summer, you could easily be getting 2.75.
Yeah, I mean, but we also have to think about everyday factors as well. I'm just playing devil's advocate here. The market's going to do what the market's going to do. Electricity costs, utility costs in general, insurance costs. Things are expensive, coming down 25, 50, let's even call it, a full point.
Inflation never
I'm not sure that's going to move the needle.
Inflation never comes down. It never does. We're up, depending on the products, anywhere from 25 to 35% prior to COVID, right? I mean, we're all sitting around the table and things cost much more. Car insurance is one that you didn't mention.
You can't not pay your gas and electricity bills.
But oil, look at oil, $60 a barrel, right? Some people would say that lower oil can be inflationary for people who spend, right? Granted, there's other factors controlling why the price is right now, war and et cetera, but what you have there is other items have offset on some points, and so gas is one of them, right? But when you look at the other tangible services and everything else, it's very expensive. Services itself is one of the highest growing items in the inflation docket right now, and it continues to be. So if people are going to spend, they want to go out, they're not going to hold back.
Right, so what's holding up GDP right now? Tech spend.
Tech spend,
that pulls
significant.
Yeah.
Right? Yeah. It's kind of kept GDP going for most part of this year.
Yeah, I mean, because we've always said, it's a strength of the consumer, but, some of the proprietary data that's not public information that we have spoken about a number of times on this desk, whether it's Kashish, whether it's Bolt, that they are, consumers are accessing more BNPL or multiple forms of credit to either consolidate or to pay for things, and their shift in spending is certainly from discretionary to consumer. I don't know. If I'm a hedge fund, I'm paying for that kind of data if I'm looking further out.
For sure, because you're not getting that in the other information. But like we talked about a few weeks ago, Shisha, was the amount of people looking for creative ways to make basic purchases, and the shift in their spending of allocating everything they basically had to their home and car payments, and trying to find other ways to spend for everything else. Kind of goes to that a balance between discretionary and staples, where staples are going to kind of win out because there isn't nearly as much in discretionary income for that kind of bottom half of income earners to go out and continue to spend on experiences and additional goods, whereas staples, you kind of have to have it. So it's that the pie of what you might be able to hold up in meeting your obligations, but you're not going to have that extra discretionary, which was always kind of what was talked about with, the consumer is really driving this market. Now it's obviously the tech spend, but for years it was the consumer. Never bet against you as consumer, and I still don't want to bet against you as consumer, but kind of where that spending is going to go, I think it'll be less on that discretionary and travel.
Well, to follow up to your point about electricity, so one of our calls for 2026 that we don't think is on anybody's bingo card is you talked about the price of oil. So price of oil has kind of been artificially held down. Obviously, a couple of wars going on, countries wholesaling, dumping oil. And once you start to see these wars unwind, there's a tremendous amount of pressure to get the price of crude oil back because the Saudis, the Middle East, they need higher oil prices. And one of the things that we've been watching very closely is U.S. rig count. U.S. rig count peaked a couple of years ago. It's been coming down because why would you drill for oil in the United States if overseas it's being sold wholesale to other countries? And so we think we're beginning to build it up. And one of the tells is if you watch, when I say energy stocks, not the electricity stocks, but if you watch the oil service stocks and the oil stocks, with the price of oil coming down, those stocks are not coming down. We think that's a tell that higher energy prices could be an impact into next year. The other thing that I think, one of the things that we always point out from a historical standpoint is that whenever you get a sector dominating the S&P 500, like for example, the tech sector right now, if you go back throughout history, there was a period of time when oil dominated the S&P, the financials dominated the S&P. After they dominated, they didn't dominate, and there was a regression to the mean.
Yeah, we just spoke about that on the panel prior to this one as well. Again, there's so many different factors, comparing from the late 90s to now, whether you're talking about market structure, the fundamental health of companies now that are, advancing the market relative to what we saw in the dot-com boom. Hopefully, we've learned something since then, but I just want to go back to the consumer point for a moment here. Even just the next generation, they're using BNPL to get purchases that they see on social media. Anecdotally, one of the communications folks that was in with one of the teams last week said, my generation, we see something on social media, we can obtain that through BNPL or any one of these other things. What they don't realize is this is getting reported now to FICO. And what that means is shorter term debt doesn't score as well. So much debt doesn't score as well, you could potentially impact the creditworthiness of a big part of the next generation. And I don't think many of them are aware of that. No,
none of them are aware of it. I mean, what's positive is we're getting a lot of younger investors coming in. So, the good thing about the crypto space the last couple of years is it's got people interested, the younger generation interested in investing. AI's got them investing. We're opening up accounts for the sons and daughters of our clients, and they're asking us these questions. So it's good that they're asking these questions. It's good that they're getting into it and investing. My fear, though, is with some of the products that are coming out, like we talked a little bit before off air, you've got leveraged single-stocked ETFs. I mean, I am amazed at my career in Wall Street, how many different ways Wall Street has figured out how to blow people's portfolios up and do it very aggressively. And it's something that I feel like, I'm holding this next generation of investors back going, be careful, be careful. Well, why should I be careful? We don't need to be careful. Everybody can make, big money. And I'm like, we have not seen an extended downturn in the market that's lasted for more than several weeks or several months. And I've seen that. And what happens is those investors lose interest and they go away, and hopefully they don't go away for a long period of time.
And we'll show them a one-day chart of the UVXY blow up in 2018, and hopefully they'll learn something from that. All right, guys, we have to hop. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.